And as you know, since then, we went through a boom in the equity markets, and now we're in a bear market, essentially. Certainly the NASDAQ is.
Welcome to Dream Richer. There's a strong confusion amongst the Feds right now, whether or not they should lower the interest rates or increase them. Whatever option they choose, the economy will either plunge into inflation or the recession. The banks have already started giving out warnings of a so-called major hurricane that will soon hit the economy. As of yet, no one knows what type of hurricane this will be. Perhaps inflation by fourfolds, or an economic recession where we will see something like the Great Depression repeat itself. Federal Reserve gauge is indicating that the US economy could be headed for a second consecutive quarter of negative growth, meeting a rule of thumb definition for a recession. Talk of recession has accelerated this year amid surging inflation that has put a damper on corporate profit outlooks. Many on Wall Street are still expecting the combination of resilience in consumer spending and job growth to keep the US out of recession. Chairman Jerome Powell said last month he sees a good chance to have a soft or softish landing, even with policy tightening. By the end of this video, Cathie Wood unravels the conundrum of an all-out economy collapse. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
Elon Musk said that he has a super bad feeling about the economy. Jamie Dimon at JP Morgan talked about a hurricane. Be prepared for a hurricane.
That hurricane is right out there down the road coming our way.
He doesn't know what kind of hurricane. Is it going to be a mild one, or is it going to be a Hurricane Sandy, which would be quite serious? But I think he's changed his tune a bit in the last month since JP Morgan reported earnings. So he sees a lot of business activity and must see it slowing down, if I had to guess. The president of Goldman described this environment as a confluence of shocks that in his career has been unprecedented. So again, he has very good perspective, global perspective, every sector. And so I would say at the margin, these three business leaders are seeing the economy in some form of stress. If you look at the macro numbers that came out, personal consumption expenditures for April came out at 0.9%. That's nominal, so that includes inflation. Excluding inflation, 0.7%. So that was a pretty strong report after a great degree of sluggishness. The reason it's surprising is we also got the University of Michigan's Consumer Sentiment Index, and it fell. It fell to a new low, and we're back to where we were in 08-09. So that is not a good place, and it's hard to understand why consumers would be spending so much. The other confusing statistic to me is consumer credit, the change in consumer credit outstanding. Now, this includes both revolving, so credit cards, and installment debt. And these are huge numbers for March and April, 37 billion and 52 billion. Normally, we're used to seeing 6 billion or 5 billion. Equities are telling us that the Fed is going to make a mistake. And even the Fed is saying we could make a mistake. The economy could enter into recession. We hope not. There are instances of so-called soft landings, but I would submit that housing and autos down 20% is not a soft landing. You're seeing in the sectors, as equities are broken out by something called GICS sectors, energy, utilities, and materials are up. Now, energy and materials are value sectors, and they tend to do well in inflationary times. If we're right and fiscal and monetary policy are both very tight and getting tighter, then at some point this is going to flip. We will flip away from this value rotation and back to growth.
Government data released Friday put inflation at 8.6%, extending increases not seen for a generation, with gas prices hitting daily records, which some believe to be fueled by Russia's invasion of Ukraine and supply chain challenges related to the pandemic. Biden, whose popularity has taken a hit, as prices surged just months before November's midterm elections, has made fighting inflation his top domestic priority. But so far, his strategies don't seem to be showing promising results. Some argue that Mr. Joe Biden could be playing the blaming game by blaming the current US bearish market on President Putin. In fact, this is what Joe Biden had to say recently. I'm doing everything in my power to blunt Putin's price hike and bring down the price of gas and food. But he acknowledged that rising inflation was a severe problem, saying in an earlier statement, "The United States must do more and quickly to get prices down."
And just hearkening back to the last time the Fed was fighting inflation and ferociously fighting inflation was under Volcker in the late 70s and the early 80s. And I was there, I was just starting my career. And I remember the Fed funds rate was at 10%. Chairman Volcker at the time jacked it up to 20% in one move. So that was up 1,000 basis points, to be sure. That's a lot. And he did it to shock the economy. But that was only up twofold. We've already gone up fourfold and potentially up tenfold. Just beginning to wonder if, the impact on the economy, starting from such a low rate and having been at low rates for so long, that maybe this is, yes, a shock to the economy. Or the biggest fight that the Fed has on its hands, it believes, is inflation. And inflation has been much higher than we would have expected. And you know the reason. Supply chain issues for much longer, almost 2 years now, more than 2 years now. And then, of course, Russia invading Ukraine, really driving up food and energy prices. So the Fed is not happy with this, and no one's happy. In fact, the consumer is very upset. Hasn't been this upset since 08, 09. But we are beginning to see signs that inflation has peaked. And Chairman Powell did say maybe it did peak in March. We got the personal consumption deflator, which is the Fed's primary inflation indicator, to which they pay the most attention. The headline PCE deflator was an increase of 0.2%. So that's 2.5% at an annualized rate, roughly. And if we were back there on a year-over-year basis, the Fed would not be tightening. Nonetheless, to see that happening at the margin is really important, and the Fed should start taking some comfort from it.
It's clear from Cathie Wood's explanation that our economy is in a state of total confusion, though there are certain good outlooks, such as Consumers Index. However, most of the experts believe we are headed right into a brick wall. Whether that brick wall comes in the shape of hyperinflation or recession, no one knows as of yet. Prices continued to rise last month for goods, including housing, groceries, airline fares, and used and new vehicles. This set new records in multiple categories, according to the Labor Department report. Some economists expected the easing of pandemic restrictions to cause a shift of U.S. consumer demand towards services and away from goods, which they said would ease inflation pressures, but prices for services increased as well. How do you think the economy will perform in future? Let us know in comments below. To learn more about the latest crypto news, watch these videos here.